No, the bond vigilantes may be out there every day, but we don't talk about them, and we haven't talked about them for years because they haven't really mattered. The Fed has been the 800-pound gorilla. What it decides matters because it's the big buyer in the markets, too. It's not just talk coming from them. It's also action. So until the Fed actually starts to taper, I have a hard time thinking any bond buyer, any investor is going to be able to sway things until the Fed allows them to do it.
Well, but they're not doing yield curve control in the United States. That's certainly the case, perhaps, in other markets. But, the Fed's buying is fairly targeted in terms of what they're doing overall. So I do think the curve, it's not perfect, but I think it's the U.S. curve anyway is fairly reflective of expectations. And I still think it's a good indicator.
In terms of what that means, though, play that out. If you have concerns about this longer term, first of all, what is longer term? And second of all, what does that mean for equities?
Well, listen, I'm an equity person overall. Unfortunately, in the last number of years, so many macro investors have morphed from trading bonds and stocks to trading factors, and they use the slope of the yield curve as a time to rotate. And we certainly saw that rotation from August. But we had almost a 90% move upward in 10-year yields in the first quarter, and that became even more pronounced. But if you're an equity investor today, even if you believe in a stronger economy and you believe in the reopening trade, or you believe in reopening and the economy getting better, which I certainly do, it's very hard to look at a whole bunch of these reopening beneficiaries who are now at or beyond their 2019 peaks and make an argument that these are good investments from here. Some of the stock prices might not be back to where they were in 19, but the enterprise values, given the amount of debt taken on, or the market caps, given the amount of shares issued, certainly are. So you were talking about this earlier with Dominic. And so, technology positioning is down, has had the biggest withdrawal of exposures in about 15 years in the first quarter. And I think from here, for you to justify owning some of these more, you talked about Avis earlier, which we don't have a position in, but some of the other names, a lot of those stocks now are well beyond where they were in 2019. And while there might be pent-up demand, earnings aren't expected to recover until 22, 23. And if you need to look out to 22, 23 to justify owning a company, I would much rather own secular growth companies than betting on some sort of pent-up demand or some sort of interesting thesis about the roaring 20s coming back. Those are reflected in a lot of those stocks' valuations.
So what names do you like? What sectors and specifically what stocks?
Look, I think the secular growth areas continue. I think the digital transformation, which a lot of people think has already occurred, has not already occurred. There's continued movement toward digital transformation of enterprise, whether that's the movement to cloud, whether that's just all processes from a business continuity standpoint or from a cost-saving standpoint are going to continue to migrate over towards this digital transformation. I also think the way we do a whole lot of things, some of the best months in terms of e-commerce sales occurred this year, not last year. And so, I think a lot of the secular trends where these stocks have gone sideways, perhaps for 7 or 8 months or 9 months, as people have gotten all excited about cruise ships and car rentals and other things like that, I think they now represent, relative to their growth, a very interesting opportunity. And I think a lot of the other stuff, which is well above where it was in 19, with no hope of returning to 19 earnings for another 2 or 3 years, from my perspective anyway, I think is a little bit more tricky from here, that's for sure.
Shepard Smith here. Thanks for watching CNBC on YouTube.